We are continually adding additional PEAT modules and functionalities. For version 2013B, what you see is when you start PEAT, Project Economic Analysis Tool, are some of these most commonly used modules. For instance, stochastic DCF or discounted cash flow analysis. You've seen that through various videos prior to this. There are also a couple other modules that I can walk you through relatively briefly. Things like buy versus lease. Buy versus lease. Here's buy versus lease capability. You can add as many of these leasing tabs as you wish. Just go to the leasing menu and add lease, delete or duplicate. Or also click on load example, and what it does is it will load a sample example for you. There's the lessee and the lessor. Typically we do a lessee analysis. Lessor is the company actually owns the equipment and leases it out to somebody. So typically that's just very limited use, but it's good analysis as well. Typically, for most firms, you are the lessee. The company actually receives the equipment, pays some fees, and so forth to lease the equipment. You can do a lease versus buy with borrowed funds. So if the funds is being borrowed, you have a cost of money in this case to see if it's better to lease versus buy. So lease versus buy analysis. You can do a lease versus buy with salvage value, which means if you purchase the equipment, you can at some point, salvage the equipment. So there's some salvage value at the end of life, economic life of the equipment, and be able to recoup some of your revenues as well. Lease versus purchase, a residual versus buy. So what that means is you have the lease with the option to purchase at the end. So depending on the situation you're looking at, you can select the one that is most relevant to you. So let's say I do a lease versus buy. I clicked on load example already. So we can do lease payments, typically either are due at the end of the period in year one or in the beginning of the period, which means you pay now, get the equipment, and then at the end of the year you keep paying. But the first payment occurs at time 0, or you get to use the equipment now and you pay at the end of the year and so forth. So typically, it's year 0. It's annuities due in this case. So the cost of the new equipment, the life of the equipment, any tax rate, and the tax rate is used for tax shield computations, loan interest rates if it's borrowed funds, any type of annual rental charge, rental as in for the lease. And when you're done with it, you can decide if you want to use a depreciation schedule, your own schedule, or use a straight line depreciation, which is a flat depreciation. In this case, is the equipment is 2 years with just depreciation for 3 years, and the reason is you start paying at time 0, year 0. So we start the computation at year 0. And when you're done, you can actually see the analysis. It says in blue, it says NPV, net present value of ownership. What is the value of ownership? So, value of ownership is negative. That means it's actually a cost. So the cost of ownership is $63 million. The cost of leasing is $64 million, even after considering the things from tax savings and principal repayments when you own versus tax savings of leasing and so forth. Then what you're comparing with is the blue versus the green, and in this case the cost of leasing is a little bit higher, therefore you should be buying, and we call this net advantage to leasing, an NAL analysis. So if the net advantage to leasing is negative, you do a purchase. In this case it's blue in color, we're saying buy. Now you can do the same thing for lease versus buy with salvage value, and again you can do as many years as you want to. In this example it's just 5 years, that should be sufficient. And what we are seeing here in this example would be that you should be leasing in this analysis. So there's some depreciation, tax savings, there's a residual value because there's going to be some salvage value, maintenance costs and so forth, but at the end you're better off just leasing this equipment. And we also have the capability of computing lease with purchase at residual value, so you have the ability to purchase if you wish to at the end, and therefore how much is this actually worth to you, and the optimal decision in this case is lease. So entering the inputs that's required in white, and you're done. In this case, you can also look at not just the lease versus buy cash flow analysis, but also a tornado analysis and make a decision on which one drives the decision the most, some sensitivity analysis, and of course net advantage to leasing in this case, so whether it is positive or negative. And notice that when the tax rate is a little bit higher or too low, your NAL is actually a little bit less, so you're better off leasing and so forth if your tax rate is at some optimal rate. So we can do some analysis on here with the lessee. You can also look at it in terms of a lessor, what the counterparty is actually obtaining in terms of value. So this provides you added value of insights to see, what the negotiation, should look like, what the counterparty would come to the table with, and what, the counterparty would find to be optimal, to be profitable, and so forth. So that's your lease versus buy analysis.